Hi everyone, welcome back to Corporate Decoder. Today we're diving into a financial filing so exciting it's like watching paint dry but with numbers. We'll be decoding Marblegate Capital Corporation's amended report. Get ready for pro forma financials and management service agreements. We're going to break down why they had to file an updated report, what it tells us about their business moves, and most importantly, what the numbers are saying. Before we jump in, if you enjoy getting straight to the point insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us for more discussion. So why the amendment? Well, it turns out there were a few mistakes, or as they call them in the fancy business world, Scrivener's errors. Think of it like typos, but in a document that could affect millions of dollars. They had to correct those errors and provide some missing financial statements. Specifically, this updated report includes financial information from De Palma Acquisition 1 LLC, De Palma Acquisition 2 LLC, Marblegate Acquisition Corp, and Marblegate Capital Corporation itself. Plus, it includes a corrected management services agreement. Let's get straight to the numbers and look at the unaudited pro forma condensed combined financial information. This is basically a what-if scenario showing how the company might have looked if all their recent deals had happened earlier. Looking at the numbers for the year ended December 31, 2024, the weighted average shares used in computing pro forma basic and diluted net loss per share is 32,578,339. So if you divide the net loss by this number, you get loss per share of 1.53. That's definitely something to keep an eye on to see if it improves, because you don't want to keep losing money per share. For the 3 months ended March 31, 25, the total operating revenues are $17,000. It's good to have 17 million in revenue, but what do they have to pay to get that much revenue? The total operating expenses are $24,676,000. So for every 17 million in revenue, they're spending almost 25 million. So that is not good. They're spending about 50% more than they are receiving in revenue. This also shows in the loss before income taxes, which comes out to negative 76,000. Now let's look at the exhibit with the updated management services agreement. The amendment also includes an updated management services agreement. This agreement basically spells out the relationship and responsibilities between Marblegate Capital Corporation and Marblegate Asset Management LLC. It details what services will be provided and how much they will cost. A management services agreement defines the scope of work that is provided, how long it will last, and the fee structure for the services. Let's zoom into the services that Marblegate Asset Management will provide. It includes things like sourcing and evaluating investment opportunities, managing investments, and providing administrative support. Basically, they're handling the day-to-day operations and strategic decisions for Marblegate Capital. Now, how much does all this cost? The agreement outlines how the management fee is calculated. It's based on the company's equity with a minimum quarterly fee of $375,000. So this is the minimum Marblegate Asset Management will receive each quarter for their services. The management fee also has additional incentives and an incentive allocation formula. Let's dig deeper into the incentive allocation. This is how Marblegate Asset Management gets rewarded for good performance. They are entitled to a portion of the profits generated by Marblegate Capital's investments, but only after certain performance thresholds are met. This incentivizes them to make smart investment decisions that benefit the company. The term of this agreement is ongoing, automatically renewing each year unless either party decides to terminate it. This provides stability and ensures that Marblegate Asset Management will continue to manage the company's investments for the foreseeable future. So, what does all this mean for Marblegate Capital Corporation? On the one hand, having a dedicated management team handling investments and operations can be a good thing. It allows the company to focus on growth and strategic initiatives. On the other hand, the management fees and incentive allocations can eat into profits, especially if the company isn't performing well. Now let's zoom out and look at the bigger picture. Marblegate Capital Corporation operates in a competitive industry. They need to make smart investment decisions and manage their expenses carefully to stay ahead. What I am seeing here is an okay direction, as long as management can improve their expenses to be less than their revenue. This is quite concerning, so the direction should be monitored closely. Also, the management services agreement shows a heavy reliance on an external entity for critical functions. While this can bring expertise and efficiency, it also creates a dependence that could be a risk if the relationship sours or the management company underperforms. So that's it for this Corporate Decoder deep dive. What do you think about Marblegate Capital's updated financials and management agreement? Are they on the right track, or are there red flags that investors should be aware of? Share your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more financial breakdowns. And don't forget to join our Discord community in the description for even more discussions. Thanks for watching, and I'll see you in the next video.